Welcome to the Chaim Investment Advisors podcast. I'm Chaim Victor Schramm. I am here with Pablo Lasha.
Yes, indeed.
And today we're talking about IBONs versus MYGAs. And we are comparing a couple of different fixed income, more conservative opportunities in the investment market, given a lot of people's focus has been on equities and what's going to happen with stocks. Is it NASDAQ going to go up? Is it going to go down? A lot of pessimism about bonds when, in my opinion, somebody who has watched both the annuity, the treasury, and the corporate bond market for a long time, I'm actually fairly optimistic going forward. And this is an interesting dichotomy to start talking about opportunities with, because there will be more opportunities later. But right now, this option of, well, if you're really concerned about being more conservative, do you go by IBONs? Do you go with MYGAs? What do you do? That is an important conversation that I haven't really heard a lot of people talking about because, again, equities get so much attention.
Yeah. So, just out of curiosity, why would people be even looking at I-bonds or MYGAs to begin with? What is really the use case there?
So I-bonds have got a lot of hype lately, and that's why we're talking about it. It's like I get asked about I-bonds so much because there's so many personal finance gurus on podcasts and on YouTube and on blogs that are saying I-bonds, go out, get them with as much money as you can possibly put in them. What they do is they go up in value with inflation and pay a fixed rate on top of that. And right now, people are very excited about, if you go on treasurydirect.com, actually it's .gov, and you look at the current rate you would get if you bought today, it's a very exciting rate. It's been between 8 and 9%. And so people are trying to get their 8 to 9%. That's why they're doing it. And a lot of them do not realize that rate is not nearly as exciting as advertised. And that's the first thing to talk about. So people are being drawn in by this very high appearance of a rate, but some of the fine print makes them a lot less exciting to me, and is why I was interested in comparing these two originally. But yeah, people are buying them because they want low risk, high return. That's
Makes
what they're
sense.
after.
Yeah.
And so MYGAs also are low risk, less high return, but probably the thing to talk about first is this fixed rate with I-bonds. And so if you go and you see this 8 to 9% rate, what you're expecting is that that's the rate that you get for the lifetime of your investment. But the fine print says that's good through December. And so that's the variable rate, is the I-bonds are inflation adjusted. So they adjust the value of the I-bonds 2 times a year for inflation. And that's the annualized rate that it's been updating the principal value of. But today's fixed rate is 0%.
Yeah.
Look at the fine print, it's 0%. And that gets a lot less exciting, because if you're running on this thesis that inflation's high forever, well, yeah, sure, buy all the I-bonds. That's probably a good idea. But the vast majority of economists and people in finance and investors actually are thinking inflation comes way back down to earth, down to the 2 to 3.5-ish zone in the near-ish future. So within the next year and a half. And so the I bond becomes a lot less exciting when it becomes 2%, 3% inflation adjusted increase and 0% fixed rate. That is, I think, a lot less return than people bargained for.
Yeah, that makes sense. And so how long are they locked into this for the I bonds? Like how long would they be committed to these variable rates?
Not very long. You can take your money out without too much penalty in the first couple of years. You can keep it in the I bond for a very long time, so it'll keep accruing value. They are savings bonds, so they're a little bit different than other types of bonds because the government limits how much you can get to $10,000 a year of purchases per Social Security number of an adult. So if you're married, you can get 20,000 a year as a couple. So they're a little different in that regard, and you can let them keep accruing interest for a long time. It's 30 years at the moment. It's been most of the saving bonds tend to do something like that. The thing that you really get hit with is a tax bill when you take your money out. That's the number one adverse consequence of realizing gains on I bonds is that it's taxed. The increase is taxed as ordinary income when you take your money out.
Makes sense. And so, we're talking earlier about these MYGAs. What is the alternative? What are we looking at here?
Right. So a MYGA is a multi-year guaranteed annuity, and so the rate is guaranteed for the whole lifetime of the annuity, and also before you buy it exactly how long the term is. I'm going to try to avoid comparing them to CDs as much as possible because they really shouldn't be compared to CDs. CDs really legally, and we do things legally here, it shouldn't be compared to anything because they're FDIC insured. None of this other stuff is. And so that puts CDs in a league of their own that we really try to not touch. But CDs, we know the term of, and we kind of know the circumstances that happen when they mature. Similar sequence of events happens with MYGAs. You have a set term, let's call it 3 years, just as an example. You have a 3-year MYGA, and that offers 3.75%. Well, every year you're going to earn 3.75%. It's going to go up that much. And with MYGAs, much like I bonds, they just add to the face value of the contract or the bond. And so it compounds. That's one advantage of these is that it does automatically compound. And the compounding happens tax-free. So if you're doing this on a large-ish amount of money, that can make a fairly large difference, especially if you've racked up a number of years in a row. And so the alternative here is one possibility right now is MYGAs are at many year highs. They had been a lot lower than they are right now. And you can lock in rates for multi-year guaranteed annuities at pretty decent rates, and then you'll have them until the end of the contract. And that is a compelling contrast to the I bond, where you're kind of gambling on the direction of inflation, which, I'm not sure that I would do that.
Yeah,
or
for
do
sure,
that
for
to a
sure.
very limited extent.
Yeah,
It's
well, that makes sense. Yeah,
that's the the trade-off there is you are not getting an inflation adjustment with a MYGA, but you are getting a fixed rate, and the opposite is true for I bonds. And so some amount of complementary effects might exist there. Like let's say that you have, talking about strategy, if you got 60,000 that you want to allocate to relatively safe stuff, you could say, well, I'll put 10,000 in I bonds and 50,000 in MYGAs. And that actually is a pretty decent strategy where you're not really going to be needing to uh, have an active position. You're not going to have an active hands-on role with either of these investments. They just kind of do their thing, and they go up in value, and eventually you take your money out. Very low key investment maintenance for sure.
yeah, that makes sense. And what do you think about the like general health of the bond market right now?
Well, actually, that's a good segue into kind of talking about how Mike is favorably compared to some opportunities. So right now, indexes are yielding for fixed income. So bonds, new bonds that are being issued right now are yielding pretty high compared to what they have, since we've been around as an investment advisor firm.
Yeah,
Certainly, you'd have to go well beyond our times to find a decent interest rate. And so bonds are yielding pretty decent interest rates. But what we know about the volatility around policy right now, and maybe you've listened to some other podcasts that we've done in the recent past where we talk about that side of things. Well, interest rates could go up. And I think both of us have probably made the argument multiple times that they should.
yeah, they should, and they probably will. I mean, already, I think like yesterday or the day before, we saw interest rates rise. From the time that we were filming this, so it'll be like maybe a week or a couple weeks for you guys. But like we just saw them like raise interest rates by 75 basis points, and I think that we'll see a continued rise in interest rates as the inflation issue becomes less and less transitory.
Right, that happened yesterday. So
Yeah,
yesterday we get a new rate hike, and
yeah,
there could be a bunch more of those.
yeah.
To be
Yeah,
clear,
I would expect that there's going to be a lot more interest rate hikes. That is like just that's what's coming. And as we see those interest rates hike, then I think that what you're talking about with the I bonds, we see the problem. With an inflation adjusted, again, these are tools, so it's not that like one tool is particularly better than another tool. It just depends on what you're trying to get the tool to do. And
right.
obviously, if you're going to have like rapidly rising interest rates, and hopefully that tampers down like inflation, when they go back to adjust the variable rate, you're going to be running into problems because they're not going to be wanting to pay you out a lot of money there. So,
Right. I mean,
yeah,
the policy direction is to get it way lower as
yes,
fast as possible. So the
yes,
policy direction is to make your I bond a lot less interesting as an investment. And
yeah,
so
yeah.
that's called there's a saying on Wall Street: "Don't fight the Fed." Um, yeah, don't fight the Fed. You know what I mean? You don't really want to
Yeah,
go against their direction. And so the bond market where it's at right now, yes, you could go out, you could buy a bond fund that is going to yield distinctly higher than it had been in the past, which is a good thing. And bond funds, obviously, I'm still out here recommending them all of the time. So, I'm not
right.
taking an anti-bond fund position, but I am going to say that there is more risk to the downside with the value of those, where if interest rates go up again, and they probably will, then they could go down in value more. And one advantage of MYGAs is to offset some of that interest rate risk and say, well, in a rising rate environment, MYGAs make pretty attractive investments because the insurance company with a MYGA is the one that's taking investment risk. So they're taking the investment risk. You are not taking the investment risk. And that might be a good idea with some of your fixed income positions going forward, giving just policy volatility and political situation that we are in now, where monetary policy for some reason has to be the only answer to all of our problems now, which is something also we've both voiced frustrations with multiple times.
Yes, that's true.
And so MYGAs, they're compelling in that environment where you say, well, there's risk to the downside that interest rates go up further. I can lock in a rate that I'm happy with and just not worry about what happens to the value. And if inflation goes way down, and let's say that they cut rates in Q2 of 2023, let's just say for argument's sake, because let's say they call it a recession at some point.
Right. Which to be clear, I think that they will. We were discussing this sort of like off camera, which is that well, I think there's a couple of things to point out. One is like the NBER, who calls and doesn't call recessions, is just a nonprofit organization. So I mean, sure, we respect them because it's an accumulation of great minds, of economists who are like respected in their field. So it's not like to say like that's nothing. It'd be the same if you were talking about some sort of association of surgeons or doctors. What they say does mean something, but it doesn't have an official capacity in any like, it just happens to be the government like respects what they say because there's a bunch of economists there, right? And the other thing is they're like often late to like call recessions, right? So
they're usually
the fact that like, the fact they haven't called a recession, it does not mean that it's not a recession. It's just like, it's one of the things, especially I think in academics, like you want to be very certain about what you say, even though it looks like almost guaranteed recession. In fact, I looked it up because I was curious. How many times did they not call the recession when there was negative GDP growth? And it happened once, I think it was in 1947. It was between two things that they called the recession. So it was between the recession in 1946 and a recession in 1948, but there was negative growth. And for some reason, they didn't call a recession. I don't think that they had as much complete data as they look at these days to call a recession. And the other thing is, there are times where they you have positive growth and then they call a recession, right? And so it's important to note that yes, that is like going to be a more common thing where you see like, well, there was real growth, but for some reason they still think there's a recession, whether it's like employment statistics or other like key indicators. But likely in like 6 months they're going to be like, that was a recession, or we're in a recession now. If hopefully it's like a 6 month to 9 month thing, we'd like to see something quick. But the fact is, like, a recession is like paying your credit card bill. It's when you are in an expansionary period, eventually you're gonna have to pay that credit card bill. Especially when your policies have caused a lot of inflation and things of that nature. So that's kind of like, it's kind of my take. I think that like Chaim is like a similar take there. Is like they're probably going to call it a recession, but not yet. So we can't say in official capacity. Well, yeah,
but yeah, I think that highlights another thing about how markets really work and how people in our industry really work is sit around and wait for guys on the mountain to come down with the recession announcement.
I've spoken to the bush and they told me it's a recession. It's like, we can see it.
Right, we're out here like making calls with dollars in real time, whether or not policymakers want to, no matter who wants to label it what, we're interested in things going up and down in value over time.
I mean, it's fair to say that, like, in the professional finance world, that people don't always get it right, and sometimes they're behind and they make the wrong decision. But in terms of timing, they usually are making that decision quicker than those people in academics. In other words, yes, we are late to the game, but they are even later to the game.
Right.
So,
And that's why they call both the bond market, so the yield curve and things like treasury auction volume and equity markets. So are things going up or down in value? Those are leading indicators for a reason. It's
yes.
like those are not lagging indicators, and
Yes.
calling
Yes.
it a recession, that can
Right.
be a very lagging indicator.
And
If we
yeah,
go by
like in 2008, it took them 6 months. And
right,
it did not take me 6 months to figure out that there was a recession because I just woke up and turned on the TV, and then I suddenly started learning what derivatives were because I was like, this seems interesting. So,
yes.
yeah,
Um,
yeah,
but let's say that it's a recession at some point in 2023, and you get rate cuts. So that might benefit the value of some of your bond funds, which is good.
yeah,
That would be a good thing. It probably means your I bonds are doing pretty sluggish at that point, but it really having MYGAs yielding many percentage points potentially above what the rates and the prevailing
yeah,
going out and buying a bond fund at that point, that becomes compelling, especially if we have multiple years like we did the last time that
yeah,
we had interest rates this high and MYGAs yielding this high. It actually took a long time for
yeah. No, I think
interest rates to recover.
that. Well, and like you make another good point, which other people who listen to the podcast will have heard us complain about Fed's what can now only be called a almost 13-year policy of not raising interest rates very aggressively. Um, and so, like, one of the situations and the reason that we talk about that and the reason that's important, obviously, we don't make those decisions, but the reason that, like, that could be complicated for people is because now you're in a situation where you must raise interest rates to bring down inflation, but you are already going into a recession. And normally, in a recession, you would be trying to cut interest rates. And so now you must raise interest rates in the face of the very thing that normally you would be using the opposite tool for. And you have no choice because of like massive inflation. So I think that is one of the concerns of people. I think, like, I'm going to be honest, like, I will say I'm not smart enough to understand what exactly the economists and the Fed were thinking when they didn't aggressively raise interest rates. I think part of it is just like the human nature to not be the person who caused the problem. You don't want to be the person that you don't want everyone to dislike you, even though you're supposed to be objective. People sometimes think that, like, these people might be immune to that, but I think it's a lot like, referees in a basketball game. You'll notice that they oftentimes don't call things against the home team as often as the away team because they just don't like fans yelling at them. So,
Right. And something we talked, it's been a number of episodes now ago that we talked about. You would ask, like, oh, is the Fed afraid of politics, or are they being bullied? And I was like, yeah,
yeah,
absolutely. They're being
exactly,
bullied.
100%. That and that there's no lack of aggression in the professional financial world about bullying the Fed. I can
Oh,
tell you
yeah.
right now that they're very aggressive about it. If the Fed were this aggressive against inflation, we probably wouldn't be here. Yeah.
Yeah.
But I
So
think that you like made some good points about about where I bonds are going and why we should have that mix. Maybe you can discuss a little bit more of your strategic philosophy in the MYGAs.
right, MIGAs have one very interesting tax strategy that I bonds only have in limited circumstances. So, like, let's say your I bonds mature 30 years from now. Well,
Yeah,
there's a few different things that you can do to offset some of the taxation, and some of that is involved, doing a partial rollover to a 529 for like kids. That can happen if you still have kids in college 30 years from now.
Yeah.
That can be a
Yeah.
thing. It may not be all that applicable to most people. They much more limited though. A lot of times you just got to like pay the taxes with I bonds. With MYGAs, at the end of your contract, you can do a you can leave it in the MYGA, which will renew again, not to like compare too much to CDs, but like,
Right.
many of you have had CDs and have had this happen. So a similar mechanism can exist in MYGAs. And who knows, maybe interest rates are even higher, but you
Yeah.
look when you get you get to know is that company offering new investors a really high rate, and what's my renewal rate going to be? You'll probably know well ahead of time. But you can at the end. So let's say that you had a 5-year MYGA. You can, instead of just taking the money and paying the taxes, which is sometimes what you need to do, or the whole plan was to do that. If you just want to go into more tax deferred income strategies after that, and the period just happens to be over, you can do an exchange, a tax-free exchange with annuities that is unique to annuities, that you can do this. You can do an exchange, a 1035 exchange. Some of you may have done it before, to other kinds of annuities. You can do it to another fixed annuity like a MYGA. MYGA is a fixed rate annuity. You can do it to a different flavor of fixed annuity. You can do it to a variable annuity. You can say, well, now I'm going to open up an investment only variable annuity and invest in bond funds instead, and not pay taxes on the bonds income or increase in value. And that may be a more appropriate strategy at that time. And none of those things involve paying taxes. And so
Yes.
that's unique to MYGAs, that they actually can be very tax strategic. And I've always been very interested in that element of MYGAs, which is really only a few flavors of annuities. It's that kind of strategy applicable to. Um, yeah, because most assets you got to pay the taxes on a pretty reliable schedule, but uh, or do something to offset them. But here, you can actually just follow the best uh, tax and yield efficiency available at the time when it comes time to make the decision. And that's uh, how I tend to plan with uh, that kind of a fixed annuity.
That makes sense. Yeah, that seems like a great advice. I think that might, maybe if people were new to just the purpose of these kind of bonds or these sort of fixed incomes, they would they have better understanding. And then like also if you were just like, hey, I'm seeing these great rates on I bonds, I've been hearing about I bonds everywhere. Is this what I should be putting my money into? Maybe perhaps we've cleared up a little bit like what your strategy should be and where I bonds fit in that strategy, and maybe like MYGAs are a better fit, And obviously like we love questions. So if you guys have follow-up questions, we want to like, be addressing those in future podcasts. It's like a great opportunity for us to help educate both clients and the public. So.
Right. The MYGAs usually generate a lot of questions. Anytime we
Yes.
talk to write about them,
Yeah.
one of the most viewed ever articles on ChaimInvestmentAdvisors.com to this day is an article that I wrote about MYGAs. Because I've done work with MYGAs for a long time now. This is like almost 7 or 8 years that this is something I've been working with. So yeah, I've done a lot of work and writing about them, and they tend to be uh, fairly simple in many regards, but there are interesting loopholes within MYGA contracts that might be of interest to people. Some of them have liquidity provisions. Again, unlike CDs, so this is another thing that's very different from CDs. MYGAs might let you take out a percentage or a dollar amount, flat dollar amount per year from your MYGA contract without paying any penalty and without really incurring much consequence. So it might say like you can take $10,000 out every year without penalty, and so it might have a liquidity provision. It might have a market, an MVA, a market value adjustment. Usually that's a bad thing and you don't want that particular one. And so shopping around for them is definitely something that, people like us and other advisors who really are experts in MYGAs and how they work, good to work with because some of them are better than others. The highest yield, much like bonds, that's one last thing I will say about MYGAs. Much like bonds, they have credit ratings, and credit ratings are something to pay close attention to. So let's take Nationwide as an example. Nationwide has an excellent credit rating and tends to pay a pretty decent interest rate on these. That might be a lower risk long-term investment than buying like a 10-year MYGA from a company that has a very low credit rating. Sometimes that can be a risk. Most insurers with very good credit ratings just never really run into much of an issue. You never really think about it again. And in fact, it's pretty rare, I would say, to see major credit rating moves, even on some of the like middle rated insurers like Ocean View tend to and not commonly see very much up or down grades simply because insurance is a pretty slow and steady business by nature. And MYGAs are essentially an insurance annuity contract.
And we like it that way, right? We don't want it to be too exciting. There are places for speculation and excitement, and we don't really want that to be happening in the insurance industry.
Right. Yeah, and so this is fun to talk about, fun to think about, and some people right now doing their rebalancing. For some of your fixed income, maybe it's worth talking about instead of just buying that much more bond funds, saying, well, let's take a slice and put it in MYGAs, at least for some amount of time that we determine to be a good amount. So 3, 5, 1 years, whatever it may be. There's MYGAs for all of those time periods. You don't want to go like as far as you would with treasury bonds, which go all the way out to 30 years. Probably 10 is about as far as you want to go. But 10 years is actually quite a long time in the investment world.
Yes, I agree. Yeah, that's great. I think hopefully, like you said, we'll get some questions, some follow-up. I think like you were talking about, it's one of the most viewed articles. So if you have any questions and you guys want to learn more, definitely email or contact us.
Or hit us up in the YouTube comment section. We always answer comments as well.
Yes, that is correct. And yeah, we'll be doing some more podcasts soon.
Excellent. Well, this has been fun. This is Chaim and Pablo, and we will be talking about something probably more less technical next time.
We're also trying to turn this corner with a little more positive podcast. We know we've had a lot of doom and gloom, but we hope that we try to put like a positive spin on all of our podcasts. So.
Right, and this to me is one. Interest rates and fixed income becoming a lot healthier going forward. I'm very optimistic. Hopefully that comes across.
Yes, I agree. Totally.
Excellent. Well, we're out, Chaim and Pablo, and we will see you next time.
Yep.